Welcome to another video of fundamental analysis. In today's video, I am analyzing HDFC AMC asset management company. This company is basically has two principal shareholders, HDFC and Standard Life Investments Limited (SLI). They own around 52 and 21% respectively. This is up to date till June 30th, 2020. The average assets under management of the scheme of HDFC Mutual Fund for the quarter ended June 2020 stood at around 3,56,183 crores, which was earlier 3,62,538 crores in the previous year's quarter of 2019. The company is an investment manager to HDFC Mutual Fund. HDFC Mutual Fund is one of the largest mutual funds in the country. HDFC AMC was incorporated in December 1999 and was approved to act as an asset management company for HDFC Mutual Fund. HDFC AMC has a diversified asset class mix across equity and fixed income and others. It also has a countrywide network of branches along with a diversified distribution network comprising banks, that is HDFC Bank itself, independent financial advisors and national distributors. The company's net profit for the quarter ended June 30th was around 302 crore rupees, a quarter-on-quarter increase of around 4%. The company is one of the India's largest mutual fund manager with quarterly average assets under management and market share of approximately 14.5% as of June 30th. Quarterly assets under management of around, or rather 3,562 billion as of June 30th compared to 3,624 billion. This is the total assets under management based on quarterly average. The quarterly average assets under management in the actively managed equity oriented funds stood at around 1,293 billion. The ratio of equity oriented AUM and non-equity oriented assets under management is 39:61. That is 39% is equity contribution and 69% of the assets are invested in non-equity oriented schemes, compared to the industry ratio of 38:62. So it is very near to the industry standard. And there are 3.11 million systematic transactions, that is, this kind of transactions are happening with a value of 9.6 billion processed during the month of June 2020. So this shows that there is a constant activity into this scheme. As of June 30th, 51% of the company's total monthly average assets under management is contributed by individual investors compared to 50.5% for the industry. Total live accounts stood at 9.4 million as on 30th June. Unique customers as identified by PAN stands at 5.6 million as on June 30th. Let us look at the financial highlights for the quarter ended June 30th. Operating profit for the quarter ended June 30th was 300 crores compared to 381 crores in the previous quarter. This is a decrease of around 21% in the operating profit. PAT, profit after tax, for the quarter June 30th was 302 crores compared to 291 crores for the quarter ended June 30th, 2019, which is an increase of around 4%. So this concludes in brief the company profile. Let us move on and look at the detailed review of the company's financial statements. Let us look at briefly the summary of the P&L account and the balance sheet. What are the sources of fund and how that fund is distributed over different assets. The total balance sheet size is around 4,300 crores. Of that, the company's debt or borrowings is zero. The total equity contribution is 4,000 crores, which is around 94%, and other liabilities is around 6%. Let us look at the distribution. Assets is a very small percent, 4% of the total assets are in actual fixed assets. Accounts receivable, very small amount. So what we'll do is we'll concentrate mostly on investments. Maximum distribution of capital is in investments of 3,945 crores. The cash holding is also a very small amount of 27 crores. Other assets are around 5%. In the profit and loss account, this is up till June 2020. The total revenue generated was 2,082 crores. Let us look at the expenses. Operating expenses were around 22%, 417 crores. Interest cost 0, no interest cost because debt is not there. Depreciation expenses also very nominal at 52 crores because assets are very low. Taxes paid is 331 crores, almost 17% tax paid on the revenue of 2,082 crores. And net profit for June 2020 was around 1273 crores, which is around 67% of the total revenue. Let us look at how the company is managing such net profits, and we'll also look at the cash flow statement in detail later on to understand how the company's cash flow statement looks like and if we can find some red flags in them. Let us begin our analysis of the company's financial statements. The analysis is of HDFC Asset Management Company. We'll begin by looking at the balance sheet's equity portion and the debt portion. As mentioned, the debt is the total assets is 4,300 crores, debt is 0, and most of the total assets are from equity or from net worth and retained earnings. So the total assets are 4,300 crores and the total net worth is 4,030 crores. Return on equity looks at how much profit the company has generated on the total equity invested into the business. So in March 20, the total equity contribution or net worth into the business was 4,030 crores. On that, 1,262 crores of net profit generated in March 2020, which is around 31.3%. Earlier in March 17, around 3 years back also, the return generated was around 38.7% on the total net worth. Since the company is listed a few years back, we don't have the March 15 data. If you look at the average of the last 5 years approximately, it's around 34.7%, and in the recent 3 years 31.3% return on equity on an average basis. So this will be considered very good. Return on capital employed is also very high at around 41%. In March 20, of the 4,030 crores employed into the business for the business activity, company earned a profit of 1,662 crores, which is around 41.2%. Earlier in March 17, we look at 56.2% of ROCE, which is also very good. That is why the company commands a very high valuation in the market. Looking at the average of the last 3 years, it's at around 44.3%, and the last 5 years at 50.1%. In this last 5 years, it may not include the entire 5 years, so you will have to consider that while analyzing. So I rechecked, the data is from March 16, March 17, March 18, 19 and 20. So we have a data of 5 years inclusive from 16 to 20. So the 5-year average ROCE is around 50.1%, but the 7 years is not correct because the company was listed around 5 years back. The 3-year average is also very high at around 44.3%. So we want to invest in companies which generate high returns. Although we would have to buy at a higher valuation for such companies, but we can always wait for opportunities like the COVID issue or any other kind of problems that comes in the economy, not in the company. Return on assets, total assets employed 4,300 and profit generated around 1,262 crores. This is the total balance sheet size. Again, a very high efficiency company generating almost 30% on its total all its assets, including assets, fixed assets, investments and so on, everything inclusive. Earlier also 34.4%, a very good return, although it's been we can see the gradual drop, but that's okay. But this is also very high. Debt to equity would be 0. The company is debt free. Equity is contributing around 4,030 crores. We'll look into this detail as to what is this equity portion later on. Now, whenever you want to put money into any of your companies, you have to look at all these details and in a very minute manner. That is, you have to go deep into all these numbers and not just depend on ROE, ROC. Look at all of that in totality and then decide what you want to do. Are the valuations correct? Are the profitability numbers good? Is the cash flow statement in order? How is the profit and loss account looking? What is the trend over the years? Everything has to be understood. Otherwise, if you look at a few ratios and you don't give enough time to understand the company that you're investing in, then you'll keep doubting your decision of investing in a particular company. Even if you buy high, which of course I don't recommend, you have to buy in a staggered manner, going downwards gradually, and invest over a period of time. So let's say if you are going to invest for 5 years, then take your time investing for 1 year, at least 1 year, 1.5 years, just investing, that is putting your money. So even if you have a lakh rupee, put 5,000, put 10,000 gradually over one month. Don't rush into investing everything at one go. Buy over a period of time, make a good average. Anyways, you're going to hold it for 5 years. So no harm in spreading out your investment over a period of 1 year. If you have more money, you can increase your exposure every time you put in, maybe say weekly, maybe monthly, maybe quarterly, however you want. It depends upon you. So you can do it that way. Moving on, assets were very small, we saw just 157 crores. So no need analyzing this too much. The company's assets have increased from 31 to 157 crores. So that's okay. Very nominal growth in the total assets. And the company doesn't require too much assets also, because it's a service oriented business, lending out, and in major of its chunk of business is investing shareholders money, or rather investors money, or the unit holders money. Debtors again very small, 61 crores, 1.4%. We'll just ignore this as well. Investments is a big chunk, and this will study in detail either by going into the annual statement of the company of March 2020 and specifically looking at the investments portion. Also study the cash flow statement, what kind of investments they are doing. So out of the total assets, most of it is in investments of 3,945 crores, 91.5% of that. March 17 it was 77.3%. So this will have to study in detail. So whichever is the maximum contributor of the balance sheet asset side, we have to look at those in minute detail. Cash holding a very small amount, we'll ignore this also. No capital work in progress, no assets being developed as of now, just 5 crores of assets under development. These are fixed assets. No inventory, the company is not in a business of manufacturing or sales. Look at the growth, revenue growth, how the company has been growing. So we have the data from 16 till 20. So for 3-year data, we can take from March 17 till March 20. The growth is around 10.65% from 1,568 crores to 2,124 crores in March 2020. This is the amount of revenue or top line profit it has generated. Not profit, but revenue. From March 20 to the recent 12 months June, there is a slight drop due to COVID from 2,120 crores to 1,900 crores, a 10% drop in its revenue over the recent 12 months. So we have the data of the entire year of March 20 and then the recent 12 months, which includes 4 quarters from June 2020, then December 2019, then October 2019, and then June 2019. So we have June to June 4 quarters, or rather from October, December, March and June quarter, like that. So these are the recent 12 months. Moving on, so the company has been performing at around, growing its revenues at around 10.65%. So we want to see kind of a growth, positive growth in the revenues. Net profit also was growing exceptionally well at 31.9%. In March 17 it had earned 550 crores, and in March 20 1262 crores. Although in the recent 12 months, that is in the current quarter of June, it has slightly increased by 0.8%. So not much of a gain, although from 3 years back the profits have grown exceptionally. But we want to see this continuity in the growth in profits. So we have to keep this, whenever we are investing, we have to keep the profits also in our lookout. Debtors we can ignore. As I said, debtor days is not important for financial company. Raw material cost would be 0. Employee cost is approximately around 10.2%. Earlier in March 17 also, approximately 10% is going to the employee cost. Looking at the expenses, how or where the expenses are happening, and whether the expenses are stable or not, is very also important to see, because this gives us an understanding as to how well the company is managing its expenses, and therefore shows up on the management efficiency. Interest expense, debt-free company, just 9 crores, a very small portion, so we can ignore this. Depreciation also we can ignore, just 52 crores, 2.7% in the recent 12 months. In March 20, 2.4%. Not much of assets of the company, so very less depreciation also. Company paid a tax of around 391 crores, up from March 17, 250 crores. So we have to see the percentage. March 20 they paid around 23%, which is around where it should be, around 25% or so, because that's how most of the company's corporate tax rate structure has dropped. So this is all right, doesn't seem too much manipulation here. But when we look at the cash flow statement, we can compare how much it paid or how much it showed in the P&L account as tax paid, and how much was actually paid via cash flow statement. So that will give us an estimate as to how much there is a variation between what is shown in the P&L account and what is shown in the cash flow statement. Other income is generating 19 crores in March 20, 172 in the recent 12 months, 9%. But it's not even more, around 10-20% is all right. It should not exceed too much. Then what it means is the company is not generating revenue through its main business activity, rather through other incomes, and that's a red flag basically. So this is all right here. March 17, March 20, a very nominal figure generated through other income. Most of its income is generated through investments. OPM will be high, operating profit margin, because all the expenses are mostly in the interest cost, taxes and depreciation. But again, depreciation and interest is very nominal, so most of it is getting converted into NPM or net profit margin. Average of the last 3 years is around 47.4%. This is okay. Net profit versus cash flow from operating activity. So we want it to be near to each other. Mostly financing businesses like HDFC Asset Management AMC would have a negative free cash. So we have to understand why it is having a positive free cash. Earlier in March 17, it showed a profit of 550 crores and a shortfall in its cash generation through operating activity of 455 crores. That's a 17% shortfall. Whereas in March 20, it had almost generated the same cash as the profit declared. So 2% higher cash generated than the profit. Looking at the averages, 1 year, 2 years, there can be some fluctuations, but if we club it together and average it out over 3 years and 5 years, we can see how that net profit is comparing with the cash flow. Are there a lot of variations? So in the last 3 years, there was a cash shortfall through the operating activity of 4%, but in the 5 years, 2% gap up than the profit declared. So this is all right. There is not high variations from the profit declared. Now, what are we going to understand from this is that if the company is declaring a profit, is it receiving that profit or not in cash? That is important. So even if the company is declaring high profit but is not receiving cash, then that's a kind of a red flag. And then you need to go deep into the cash flow statement and understand why the company has not received cash. What is the reason of not receiving the cash that was shown as received in the P&L account? So most of that has not been received. So that is a red flag automatically for me. But then of course we can go into the cash flow, look at in details, but then this requires time, effort, patience to go through all the things before you finalize on investing in any company for that matter. But most people wouldn't do that, wouldn't even watch my video for 1 hour. Very few of you will do that, take that effort, time, have patience to listen to what I'm saying. But most people just want tips right away. They want me to tell them invest, don't invest. They'll not even bother to go through this step-by-step understanding. But that's okay. For people who want to do it, this is the correct way of doing it. At least this is how I go about. Okay, out of the cash generated in March 20 of 1,285, 928 was put back into investing activity. This investing activity includes all your investments, whether in fixed deposits, but not fixed deposit, but rather fixed assets, and then into mutual funds or debt funds or whatever. So all of these investments are done. So we want to see, because this is a financing company, most of its cash generated should go back into investing activity. 39% earlier gone into investing activity in March 17. Out of 455 crores, 176 was put back into investing activity. Here in March 20, it's almost 72% going into investing activity. So when we look at specifically cash flow statement in the annual statement of annual report of 2020, there we'll understand in more detail as to what is going on in the investing part, what is going on in the operating part and the financing part. Now on an average basis, if we see last 5 and 3 years clubbing together, 3,994 crores earned in last 5 years. Of that, 70% was put into investing activity. Even in last 3 years, 84% put into investing activity. So these are good numbers. So you want to see kind of a stability in numbers, whether there is a haphazard or a very sudden move in these numbers, then that also points out to kind of a red flag, and we should be little cautious or alert when we see large fluctuations in numbers over the years. But the data of course is only from March 16 till March 2020, so we don't have much data to work on. NPM margin is very high. Of course OPM we saw earlier, that was high, and there are no interest costs, no depreciation costs, so most of it is getting converted into NPM margin. So in March 20, out of the total revenue generated of 2,124 crores, 59.4% was kept as net profit in the company. Here in the recent 12 month also it is to 66.6%. So this is a very high NPM margin company. In terms of cash profit margin also, it's very high at 60%. Company has earned almost the same cash as the profit declared on a total sales of 2,100 crores in March 20. Earlier in March 17 it was around 29%. You don't understand any of these numbers or any of these ratios, let me know in the comment section. Depreciation as a percentage of gross block. So total assets on the company's balance sheet is around 207 crores. Of that, the company is depreciating it very fast at around 24.3%. That's okay because these assets are very small compared to the total balance sheet size, so we can ignore this. Generally there are different depreciation rates on different assets. For example, if they have bought computers, so the computer life is very small, say 3 years, so they'll depreciate it very fast. If the most of their assets are computers, then that will get depreciated faster. Let's say if they have bought a building recently, then the building depreciation rate is smaller or lower for 10 years, so 10% every year and so on. So it depends on what is the depreciation rate or what are the assets of this 207 crores, what is included in this 207, what type of assets are there. Is it building, is it plant, machinery, or is it like a patent or copyright or whatever, like softwares or computers. So it all depends on what kind of assets are there. So that you can also look, if you want to understand, you can go to annual report, look at the gross block or gross asset section and understand what kind of assets the company has most. Also, since it's very small, I'm ignoring it for time being. Company paid a dividend of almost 50%. The dividend payout was 50% of the profit. So company paid 596 crores in March 20 out of the total profits of 1260 crores. Earlier in 17 also 42.1% paid out of the total profit. So company is a very high dividend payout company. Most of its profits are going back to the shareholders. So if you are interested, or if you are looking out for a high dividend paying company, you can go for this company. Although as a percentage or dividend yield it would be less, because you're paying a very high price, and on that price basically you're getting less dividend. But when you consider from against the profits, this is a very high payout compared to other companies where they pay out around 20% or so. Current ratio currently has dropped below 1. Total assets are 203, liabilities to pay is 279 crores. But since the company is debt free, has a backup of its parent HDFC, so there wouldn't be any issue in basically paying off the current liabilities. In March 17, the current assets liability ratios was good at above 1.9 times or around 1.9 times. Inventory turnover would be 0 because there is no inventory in the business. Interest coverage would be high because the company's interest cost is low. As of the recent 12 months, just 9 crores paid on a total EBIT, earnings before interest and tax, of 1612 crores. Let us look at the valuation, how far away it is compared to the revenue it is generating. We will have to buy it by paying 24.7 times more than the sales it generated in the recent 12 months. So the current market cap or the total company value in the market is 47,000 crores, and on that the company earned or rather generated sales of 1900 crores. So this is a good way of valuing a company against its sales of either the recent 12 months or March 20. So you can see March 20 it was around 21 times. So it depends upon you how much multiple you want to pay, how many times more you are willing to pay for this company. You can look at the peer group companies, how much they are trading against their revenue generation that is in the market. So this is, I'm comparing the total. We can compare it per share also. So you'll have to divide like what is the market price per share and what is the sales per share. So you will get the same ratio of 21.2 times. But here, rather to understand what is the total sales taken place and what is the total market cap, I've used the entire numbers. So this number seems as against this revenue generated seems very high. Generally market cap to sales should be maximum around 7-8 times, but depends upon the sector to sector also, or industry to industry also. Price to earnings against the profit earned per share of around 59 rupees till the recent or the latest price earning, 59 rupees of profit per share, and the price per share is 2215 crores. Sorry, 2215 rupees. So we are paying 37 times more than the earnings of the company, which is quite high according to me. Should be less than 25 times. But then if it never comes down from years, then we have to take the average. So the average of the last 3 years was around 35.3. So whenever it comes below this, you can always consider as a buying opportunity and maybe buy it at a gap of say 35, 34 times, 33 times, 32 times of the latest earnings. So that you will have to calculate by dividing the price per share divided by the earnings per share. So for example, let's say you want to buy, currently it is available at 37 times. So what would be the price at, let's say you want to consider buying when it drops below the average, which is around 35.3, but will not buy at 35.3. Let's say we want to buy at 32 times. We are comfortable buying at 32 times. So you can just open up your calculator. So the price per share is 2215 divided by, let's say 32 times. We don't want to pay more than 32 times. So that would be a profit of around 69 rupees. It has to earn a profit of 69 rupee 20 paise. So in this case, what we'll have to do is earnings per share right now 59.8 rupees for the current quarter, and we want to buy at 32 multiple. So we just multiply it by 32 times, right? So we get a price of 1913 rupees. So we can consider buying at 1913 or 1920 rupees per share. That is one way to buy it. Then let us say that you want to buy at 32, 31, 30 and so on, 1x lower or 0.5x lower. So next would be 59.8 multiplied by 30, right? Previously we took 32, so now 31.5 maybe. So it would be at 1883 rupees per share. So this way you can multiply the current earning per share with the multiple that you are willing to pay. So then you will get the price that you should pay to buy each share. So you can consider this way also. So you will know at what multiple or how much multiple you are paying to buy each share. I hope you understood this. This is the first time that I am explaining this ratio, this way of buying it. So average, you can consider buying below average and then decide what is your comfort level, at what price earning you are willing to pay, multiply it by the earning per share. Therefore you will get the price that you will have to pay, or that you should pay, or you are willing to pay basically, to start buying into the company. So this way you can buy at multiple, let's say starting from 32, then 31.8 for example, then 31.6, 31.4 or whatever combinations you want. I hope this was clear. Price to book is similar way, very high, trading at 11.2 times. Let's look at the last 5 years average, 4 years average, 3 years average, and consider where it has been trading, because many of these companies you will never get it at 2.5x, which is my benchmark. So you will never be able to buy into these companies, and they will keep going up and up and up. So if you want to buy into these companies at these valuations, then because why the market has given such a high multiple price to book to these companies, earlier we saw ROE was extremely high, ROCE was very extremely high, no debt, a very low interest cost, very well managed company. So if everything is good, people are willing to pay a high valuation for it because it has a lot of safety in it. Its parent is HDFC and so on. So you have to consider everything in totality and not just get hooked up on because I won't buy when the price to book is very high. So you have to take this into consideration. Currently the market cap has gone up from March 20. So in 3 months it has gone up from 44,960 crores to 47,145 crores. So not much of a increase in the total market cap or price per share from where it was in March 20 when it was a good opportunity. But again, there are two also we saw 11.2x. Now this price to book is quite expensive. Let us look at how it was over a period of last 3 years or 4 years or 5 years. I don't have the data of the last 3 years, the market capitalization data or the market value of the data. So we won't be able to compare this, but you can look at different websites to see what is the industry price to book in this particular sector, and then also consider the same way of calculation. Let's say you want to buy at 10x or price to book, then you just multiply the current net worth 4,000 to 4,029. Let me calculate and show you. Say 4,029 is the net worth or equity contribution in the business, multiplied by, say, let's say 10x, so 10 times. So basically you will have to pay 40,290 crores. So now we have to take it per share, so we'll have to divide by the number of shares. So the number of shares currently, whatever it is, so you have to do it in this sense. Either take price per share and the book value per share and get a multiple out of it. Debt is 0, so debt to net profit ratio we can skip. If you want to understand this, you can watch other videos. I have explained in detail what this also means. This is also one of the important ratios to look at. Valuation ratios would be very high, as I mentioned earlier. Price to earnings is 37, price to cash 36.7, price to book 11.7, market cap to sales is 22.2 times currently. So very high valuations, but if you are willing to pay such high valuations, there is safety, there's high growth, but then you also have to buy at a correct time and not just rush into buying anything at high valuations, because then you will not be able to generate returns for your investments, or you may have to wait a longer time to generate returns. I believe the market always gives you opportunity if you wait patiently, but that is what most of us lack. Patience is what we lack. Let us look at price variation. We don't have data from 15 onwards, at least in this data that I've sourced from Screener. I don't have data from 17 onwards, but we'll look at the technical chart and then we'll see how it has progressed, how quickly the price has moved. So we'll skip this for time being, but the current price as of today is 2,215 rupees per share. Let us look at the quarterly P&L analysis. Sales has seen a degrowth from June 19 to June 20 of around almost 20%, from 504 crores to 411. That is understandable because of this COVID issue. Even from March 20 to June, it has seen a fall. So both on a quarterly YOY and Q over Q also, both ways, it has seen a negative fall of around 18.4 and 13.6% in its revenue. Net profit margin in June has increased to 73.5%, but on a lower base of 411 crores of revenue generated. So the revenue has fallen, but the profit has increased, and therefore the NPM margin has increased. In March 20, June 19, the NPM margin was above 50%. Profits have been positively growing both YOY and Q over Q. Earlier we saw that the sales dipped or had seen a negative degrowth of around 18.6% and something around 14. So, but in the profit portion we see a reverse of that, where we see a growth in its profit rather than both the revenue and the profit dropping. So this we'll need to analyze further. So wherever we see kind of or we have a doubt, we have to investigate, not leave it, and go deep into it, understand why such a thing is happening, and then take a decision. So this completes my analysis of the financial statements of the company. In the next part, I'll look at the cash flow and the rest of the stuff, the peer group analysis, then your technical analysis, and intrinsic price calculation. Mostly intrinsic price won't happen because I don't have the data of the last 5 and 3 years, so we can ignore that. But at least on a technical basis, I'll tell you where I feel that we can start buying